Hello and welcome to today's episode of The Modern Investor Journey. My name is Rod Hurd, co-founder of SmartBe Wealth Inc. I'm here with my partner and co-founder Art Johnson, and we're really happy today to be welcoming Sam Rook, who's a portfolio manager with RBC Wealth Management, and he's also a wealth advisor. Welcome, Sam.
Thank you, Rod and Art, and it's a pleasure to be here.
We just had another young advisor on and having you on as well, and how this business is being transitioned. And I think that's one of the fascinating areas I want to delve into with you. But it's a real pleasure to have you on, and then just share some ideas on your growth in the business and various things. So it's going to be a really fun conversation.
I'm really interested in sort of first off to understand how you got into the industry and how you sort of gravitated in your career towards quantitative finance.
It's a good story for me. It's a little different path than a lot of people take. I started out really when I came out of university. I was working for RBC's call center on the bank side of things. I would be the one that would answer wherever you are in Canada. And that led to me to transition out of the call center to a job as an assistant with an advisor who ran predominantly a mutual fund business. That really, as you start to learn a little bit more, wasn't the type of business that was for me. And I left and started working for another advisor within the firm, and had worked with her for 13 years. Early into my start of those 13 years, but 3 or 4 years in, she started to make it clear that her succession plan was for me to take over the business. So it allowed me the time to have someone with real experience who knew the old way of doing the industry, but also understood that there was a new way and a lot more modern thinking that was coming. And as you get into your career, and you've been doing it for a long time, you do it one way and that's the way you have success. But she was very good at understanding it's not going to be this way in 10 or 15 years. So she let me do a lot of the other stuff to build up my own confidence and my understanding.
The other narrative we just had as well with an advisor in Calgary here, a similar story. The young guys come in and they're kind of tasked with the wealth management side of the practice. And can you dive into that a little bit? Like, how has the business changed? How did that help embolden your ideas? And where does planning and wealth management, like what does that mean to you? And because that's probably been over the last 10 years, the biggest change in the advisory business.
Wealth management and planning, or financial planning, are essentially the same topic. I think wealth management is more of the overall umbrella, and financial planning is a big portion of wealth management. Wealth management also includes investment, portfolio management, tax planning, and all these other things that are short-term or medium-term. But the financial planning, to me, is really the foundation of everything that I do, because in the old days, people would give money. We'd try to get the most return possible. We would buy this stock or that fund and hope that was the right decision. But it didn't inform what the actual goals of the client were. Everyone thinks that they want to have retirement, but everyone's vision of what a retirement is entirely different. Too often we've had our entire country, and this is probably true of a lot of countries, where people are really not really saving or planning this until they're late in their careers and it's close to retirement. Financial planning allows them to understand, if they start a little bit of work now when they're young, it makes the decisions when they get close to retirement a lot easier, and they make a lot less mistakes. It's really the big thing for me. It's, instead of trying to chase returns and chase good years in the stock market and good stocks that have gone up, it's trying to set the plan so you don't need to do that. You just do what you do.
This is a really important topic from the standpoint that the newer advisors are taking this very different approach. One of the unfortunate things in our business is that financial planning and wealth management, in still a lot of corners of the industry, is seen as just another transaction. And that's a real disservice to actually the whole industry. And it comes back from this transaction culture. So not only was it a stock transaction or a fund transaction or some other transaction, well, now I'm still in this culture where I'm just going to do this financial plan, which is just another transaction. But that's not what people like Sam and that are doing, where they're actually becoming true wealth managers. So I'd like, to expand on that idea, Sam.
Modern pushes into financial planning, and that really now should be based on the financial plan as the foundation of everything that you are doing for the client and everything that's important for the client. And that is not just managing the investments or making sure that they have the right insurance and the right amount of insurance, but it's also things like making sure that their cash flow meets their needs. It's making sure that their estate is planned properly. And really, more importantly to it all, is the financial plan, to me, is not a map or a roadmap, as a lot of people describe it, but it's a compass, because your life is going to change. And the financial plan has to change with that. And you can't make any real investment decisions. You can't make any real insurance decisions or estate planning decisions without understanding what the client wants, what the goals are, what the family feels is important to them, because that's something that's different for everybody.
How often do you find that in that compass analogy that you have to reset, sit down, and ensure that you're tracking along with where the family's goals and objectives are?
My own process that I do, we review the financial plans every 2 years. It's a wonderful program that we've developed in-house at RBC, and I think it's fantastic because it's very, very clear. And we get caught up in the day-to-day ups and downs of the investment and the stock market and the bonds and interest rates. But the plan shows them, okay, at the end of this year, you're supposed to be roughly around here. So if that's $1 million of all of your assets, and then your house and anything else is a separate entity, I'll get them to pull out the plan near the end of the year. And we're just going to sort of start going through that in the next month and say, okay, at the end of 2020, you were supposed to be at $1 million. Are you within plus or minus 5% of that? You're fine. Are you way above? You're doing fantastic. If you're way below, well, maybe we need to look at some other things. And that forces clients to step back and ignore the day-to-day moves. March was not fun. And a lot of people were very, very stressed out by the market returns and how their portfolios looked. But a lot of recovery has happened, and it gives them a chance to say, wait, I'm still on goal. I went through all of that, and I'm still on my goals. I'm still on plan.
So do you use it as a sort of a behavioral coaching tool to ensure people stick with their philosophies?
Yes, certainly when I do the reviews, and I will call people up and say, we did this plan 2 years ago, or if nothing's really major changed in their life, it could be we first did it 4 years ago and reviewed it 2 years ago. And then we look at it to say, okay, you're on plan. You don't need to make major changes. You don't need to suddenly make up everything that was lost in March, because you're still within your goals.
I think one of the things that comes from being in this holistic side of the business, there was a recent thing going around on Twitter on what investors' expectations around returns are going to get out of the stock market. And I think they're somewhere around 11.8%, which is virtually insane. But what is fascinating, when we went from, being just an investment consulting shop to actually holistic wealth management and doing planning and integrating these things, you realize quickly that most people are going to reach their goals with a 3 to 4% real rate of return after taxes and fees and that. And it's very attainable. And you don't have to take these maximally torqued portfolios to achieve their goals. And they'll actually have much better behavior. And that was fascinating to me because, I had come from the world where it was all about returns, and you have to have outsized returns, and it was returns. And then you actually see that managing risks through the planning side and managing to their goals is actually a much more fantastic process-driven outcome experience for both the advisor and the client. Can you talk a little bit about what an investment policy statement helps with a financial plan? Because I think it's a key cornerstone that people don't hear a lot about it, because people historically have not dealt with portfolio managers who have discretion over the portfolio. And the investment policy statement is an important document that actually works in agreement with your financial planning. And what are your thoughts around that?
It gives the guidelines for what the investor or the client is willing to accept in order to meet their plan goals. And that's something that is not often used. It's like we said, it's let's try and get the best return. You don't often need the best return. You just need the right return to meet your goals. And the IPS or investment policy statement allows me as a portfolio manager to build the appropriate portfolio for your risk and to try and meet your goals. I think it's something that will be more and more important. It's something that you see more and more of because it also now gives me the guidelines that I'm to invest in. When you look at other things that are happening in the world, and there's a real rise for clients in things like ESG or socially responsible investing, and all of that goes into trying to make the right investment strategy to meet the goals. And the best way to document that, investment policy statements.
Yeah, and just to back up a bit, Rod, for the listeners, what an investment policy statement is a portfolio manager by law. What we have to do is codify the actually model of what we're going to do to help you meet your goals. And that is something that is like, that wasn't done before, right? It just was an open-ended agreement that my job is to kind of grab returns. And an investment policy statement is something I think every investor should seek out. It seems like a fairly benign document. You sign it off, you kind of agree to it. There's a lot of work to it. But in something like March, when you need a compass approach like Sam was talking about, it actually codifies the rules of the road, what we're going to do in those type of situations. And that is a huge difference to actually meet the objectives and the goals on the financial planning side. And both those two documents really codify the behavior of how we can work in a trusted relationship with a customer, a client, and the advisor. And it builds tremendous trust. And these are really important documents. So
you've talked about the documents, but what the other piece that's interesting to me is really this transition from a broker managing stocks, talking with the customer, and the customer or client directing some of the activities into this role as discretionary. And Sam, as you've evolved your career, the industry has changed. Can you maybe give us some perspective about your journey along the way to discretion?
I think that's a really important step that the entire industry will make. Some will be slower than others. And I think, for me on that journey, what I realized was the best option for the vast majority of my clients was to offer discretionary management because it made the sort of the playing field level for everybody. In a transactional business, I have to phone each individual client or portfolio and deal with it one by one. And if I happen to phone someone and they were away that day and they didn't phone me until the next day or 2 days later, they are all getting different prices. And so you tend to get a skew in the overall returns across your entire client business. Having a discretionary business for me allows me to offer the same playing field for everybody. It doesn't matter if you're the biggest client or the smallest client. If you're in the portfolio, when I go to make a change or a rebalance, everyone's getting the same price. Everyone's getting the same moment of completion of the trade. And that just makes it a lot easier to tell everybody, no, now I'm actually treating you the way you need to be treated. The other benefit to me is it's allowed me to build a much more robust structure around rebalancing because that's often one of the things that doesn't happen. Clients tend to get into positions that are doing very, very well, and then we want them maybe at 3 or 4 or 5% position. They've gone up a lot, but we never ever take some of the gains, and you tend to ride up on the momentum and down on the momentum the other way. And the rebalancing just creates what I'm trying to accomplish is a much more robust and a lot less volatile portfolio.
That's a natural lead into us talking about your gravitation to quant. I think we all start there, and then you start to realize that rules and not having the human element in there as much as it's nice actually detracts from returns. And so can we lead into how that whole thinking, planning, trying to meet your goals, and quantitative solutions or factor solutions have really organized that thinking and moved you along in that whole process?
It's been a process that I think has taken a while, and a lot of that is I guess, my own initial reluctance to say, okay, I learned to do it this way, and you have to unlearn how to do it. And the way that I was taught wasn't a bad way. We were never chasing anything. I would essentially say it was a min vol or a high quality portfolio management style, which has worked. You tend to find that there's times where that doesn't work, and you're trying to find other ways to get the best returns for the least amount of risk, or risk adjusted returns is the term we use in our jargon of our industry. I started looking at a number of different things. I guess the first sort of step for me was through O'Shaughnessy. They're pretty well-known value managers and have run a number of value-focused funds here for our asset management division. It took a while. Takes a lot for me to understand it.
Change is hard.
Change is hard. Absolutely. Yeah. I got comfortable, and I really needed to understand what each of these various quant or factor styles were, and to understand how my business fit in there and how my business could be improved using this as an option. The four, I guess, the sort of the leaders. I mean, value is the big one, and a lot of people harken back to Benjamin Graham as the father of value investing, and you hear lots of stories about value investing this and value investing that. Warren Buffett is seen as a value investor. I just think he's probably a very shrewd investor with a lot of money behind him and has done very well. But then you learn about min vol or low vol quality. Then you get into things like momentum. As I got the base understanding of all of this, I started to now read other things from AQR or Think Newfound out of California, the Alpha Architect group out of Philadelphia that we know. And you start to realize, wait a second, it's not just this factor or that factor, but certain factors, to me, worked better in conjunction to accomplish the goals that I was trying to do. And this all sort of coincide with understanding the rise of the ETF industry, particularly here in Canada. I mean, the US is probably 10 years ahead in the ETF business in terms of the size. You start to wonder, okay, is there a better way to do this? Is there a more advantageous way to do this for the client that I can also build a better portfolio? Which led me to ultimately now offering for clients a what I call a core satellite or beta and momentum value mix, where I will put them into large index. 70% of the portfolio would be S&P 500 and EFI or ACWI index. And then the other 30% would be a mix of value and momentum. And that for me was understanding momentum works in good times, and it's worked great the last 10 years, and value works in bad times, and they work opposite of each other. So value has been pretty bad relative for the last 10 years, but it's not been bad. People are still doing okay. They're still good companies. It's just we're all after the momentum right now.
Art, Sam's used a couple of terms here that have different meanings to different people, and specifically value and momentum. Can you help at a very high level help us understand what those concepts mean?
What factor investing really is about is that the research showed very clearly that what the perception of someone who runs money as a portfolio manager such as me is that I have a certain skill from all the hard work and years that I've been in the business. And that skill and hard work translate into actual my brilliance in picking stocks and market timing. Well, when we looked at the research, actually, there was a huge paper that was done in 2010, and it was the first shot across the bow on the fact that people like me we're actually getting too skilled, Rod. We're actually at a certain point, if you think of baseball, no one hits 300 anymore because the batters have gotten better, but the pitchers have gotten better. And as more skill comes into a market, it's called getting more efficient. And in that paper, it showed that from the 1990s, skilled managers were about 14% of the marketplace. And by 2007, it had declined to 0.6%. And this is just normal markets. The extension of that thinking was that, okay, well, what are these ingredients that these guys are using to produce return if it isn't their stock picking and market timing skill? And what it came down to, it was that if you did a deconstruction, like, hockey does this now and baseball does this now, and you hear about sabermetrics and all of these things, if you just looked at the raw ingredients that these people are actually delivering to you, 80% or 70% of your return is going to come from just exposure to the stock market. And then the rest is typically going to come from the quality of the companies. So we call that beta, exposure to the market. The other one was value. And these are just companies that are discounted in the current marketplace, either from a behavioral factor that people don't like them, or from the fact that, it's not great business. So they should trade at a lower valuation because their profits aren't there. The momentum thing's kind of fascinating. It's basically a behavioral problem, not a problem, but it's a characteristic of human beings. We like to chase things that are moving. So if you just buy that, it's kind of like fashion in the marketplace, and you build a portfolio with no fundamentals at all. Just if you buy the stuff that's going up and own it for a quarter, you actually make money on that because people tendency to jump on the trade and you move that along. What's fascinating is what Sam has recognized is that the biggest change in the marketplace is that used to cost people 1.5%. What Sam has recognized is you can go in the marketplace now and he can buy the market for about maybe 9 to 14 basis points, probably, Sam.
Mm-hmm. Yeah.
And then he can pick up factor portfolios for 50. You're looking at what used to cost, still costs a lot of people 1.5%. Sam, the modern advisor, can move his whole practice to these market-beating solutions for about, 26 basis points. So, 20% of the cost that the old model is using. So that 80, think of this is 0.5% or a whole percent of return. That from Sam just moving you from one side of the street to the other side, getting the exact same thing, has actually increased his ability and the client's ability to meet their goals by, 0.5%. Well, 0.5% or 1% is a massive amount of money to these clients. So that, that's what value and momentum are. They're really these raw ingredients that build portfolios. So.
You kind of have two halves to your practice. You have a half that's discretionary and more traditionally oriented in a legacy of business. And then you have this modern and emerging portfolio that's ETF based, that's factor driven. Help us understand a couple of things. I'm interested in how that transition has worked for you, because I'm sure other advisors listening to the podcast are wondering how they might jump on this ship of moving into the ETF and factor world. And secondly, the benefits that you see in your practice of this shift towards a more model-based, scalable, quantitative side of your book.
Art is very correct that the costs involved are really, really a big part of that. My factor portfolio averages sort of anywhere on a weighted basis. The cost to the client is now probably about 22 or 23 basis points. That makes a big difference. And that's only going to go lower, particularly as Vanguard and iShares take more and more assets and they run the big beta ETFs. Those ETFs are going to go to zero probably in the next couple of years. And that accomplished two things. I can come to younger people with a little less money, but real potential for my business. So I'm in my early 40s. I plan to be here for a long time.
You don't look a day over 36.
Well, I appreciate the compliment. Thank you. And I'll make sure that check means this way to you, okay, for that. It allows me to reduce the age of my book, which is a concern for everybody in Canada because the assets right now are predominantly with the baby boomers. The baby boomers are now mid-60s and up. The younger generations, my generation and the generation just starting, they don't have a lot of money, but they really, really can benefit from doing all the right things at the start. And they will have the money in 10 or 15 or 20 years, and they will become great, great clients for me because of that. So I use the Quant for them because they're a little more understanding that, yes, I need to look at other things a little more based in fact and, okay, the market is going to do this, the market's going to go up and down, but how do I get in here without feeling sick in the bad times and think I'm going to be the richest person in the world on a good month? The other side of it, where I have a lot more individual security portfolios, I've used the principles of this in building that. So I may not be buying a factor or quant ETF or buying a market index ETF. but I will build my portfolio with companies that I think are growing and their business is growing and they're showing positive momentum. And I'll also build the other portion of the portfolio where there's companies that are good quality companies, just aren't being recognized for the quality of their business. In the past, I may just buy this or that. And now I'm actively looking to say, okay, what is this company doing in the last 12 months in terms of the share price performance and also the financial metrics matter, but how is it relative to everything else that's going on? I'm not actively putting everybody into a factor ETF, but it's now much more a big part of what I'm doing for the individual portfolios as well.
Fascinating experience. It'll be interesting to look over the next 5 years as you look back, which side of the book has achieved the results that you've wanted.
It's something for me now that the next step to help the individual security side of my business is to build up my strength in computer programming and to allow that data mining to be a lot more efficient.
When you look at, what you started with and what you were taught, what has this done to you from just having a philosophy, having a belief system, and having it grounded in science and having people you can go talk to? How has that made you a better advisor for your clients?
It's allowed me to spend more time explaining the things that matter to people.
Mm-hmm.
And that's really the advice that people need. They don't need someone to tell them to buy this or that. They need someone that's going to be there when they have a question about, well, we're going to have a baby. How does that impact us? Oh, we've just relocated because I lost my job in the US and I've had to move back to Canada because my visa expired. How do I handle all of that? And what are the tax implications if I'm going to move to another country? And those are the things that matter to clients.
Do you find that your conversations with one or the other groups, the ETF younger group or the separately holding accounts, are vastly different, or are those conversations starting to merge into a unified Sam Rook perspective?
In terms of the investment or portfolio management side of the things, I think they're relatively the same. People want their money to work for them. Certainly the financial planning, it's more disparate because of the age difference.
Gotcha. Yeah, makes sense.
A 40-year-old me, I have two young kids, has entirely different financial planning needs than a 70-year-old who's thinking about grandkids.
Yeah.
I think also, Sam, you've been using your age to an advantage in going into the technology sector in Toronto. Can you talk about the appeal of these type of strategies? What's fascinating about the tools that you're bringing to the table, you are maybe 40 basis points only additional cost from a Wealthsimple because of these tools, yet there is so much more you're going to do. So it's, can you talk about what the tech sector is to you and where you see the growth in that and how they can benefit from this?
The tech sector for years and years has really just been, it's only a Silicon Valley experience. There's no real tech. Nortel blew up, Research in Motion blew up. I did a lot of work and met a lot of people here in Toronto and really through a great group called Tech Toronto, who does fantastic work to build the networking side of things. You understand that there's huge and massive technology companies being built. It's all very, very early stage. We're familiar with Shopify because Shopify has boomed in the last 3 or 4 years, and they've been a fantastic company. But there's all kinds of other ones that are here and just haven't had that moment yet, and they will. And those people that are in technology, there's 3 things that I find very interesting about them. A lot of them are math or engineer trained. So they understand the math behind, wait a second, if I'm going to get the market return with a lower cost, I'm going to take that. Oh, and it's less volatile? Absolutely, I'm going to take that now. Mm-hmm. And so they're interested in that. The second thing is, in a lot of cases, they're sitting on private company shares. They may have options, they may have RSUs, all of those things that require significant planning. That's really the benefit of me because I've got all of the work, I've got the experience with that. I've got, if we really have to do really, really complex things like cross-border planning, I've got one of the top 2 cross-border planners in the entire continent on my side, and I can bring them in. So that adds real benefit to the relationship. And then the third thing is they're so focused on trying to grow their business that they are there 10, 12, 14 hours a day, some cases 16 to 20 hours a day. They don't have the time to take the call from Sam who says, well, I want you to buy this stock and sell that stock. They just want to know that, okay, I understand what you're doing. It makes perfect sense to me. We're on the plan. You're going to help me with all the things when I need the help. Go ahead and do it, and let me focus on building my business. When they come back to look at it, when it's their time, they want to also be able to understand what's going on. I explain it to them and they understand, and I can show them all the data.
So I'm sensing from your comments, Art, that Sam, part of your niche segment, the market that you're going after are white collar or tech employees in the early stage startup ecosystem. To help us understand how Sam Rook as an advisor differentiates yourself. Like, are you using these quant strategies to differentiate? Do you see that there are others that are out there trying to copy you? Are you a year ahead, 2 years ahead? Help us understand that landscape as other advisors are looking to try and find an edge. It feels like you've got an edge in 2 areas.
Just coming at it in terms of, hey, I do financial planning. Well, everybody's caught on now that you need to say you do financial planning. So that's why I use the map versus compass. I think that's a little bit, because to me, it's not we're going to do it and this is how it's going to be for 20 years. So that's a differentiation. And the quant thing is something that I would say, in most of what I come across, I'm one of the few that has pushed that way in a more serious way. There's a lot of people who say they're value investors. There's a lot of people that are closet momentum or don't know that they're momentum investors. It's an area that will continue to grow. I think it's really important to be able to offer that. I'm happy that, as far as I understand, there's very few of us that are actually doing it, because it just adds more to my niche ability. I think having a niche business is going to be very, very important in the next 10 years.
Why is that?
You can't be everything to everyone. You have to have a real specialty. You go to your family doctor for the various bumps and bruises, but the family doctor refers you to the oncologist. They'll refer you to the dermatologist. The same with the dentist now. You go to the dentist for your cleaning, but if you need like actual dental surgery, no, you go to the oral surgeon. I want to be that person that deals with the niche. I want to be that person that understands the industry up and down. I want to be the person that understands, okay, you've got restricted share units. How are you going to be impacted on the taxes? And do you need to have money set aside to pay these taxes as they vest over time? Do you need to do this? Do you need to do that? And that's just something that a lot of other parts of our economy, a lot of other sectors and industry don't have to deal with.
There's embedded wealth there that they may not be able to realize, and different strategies to kind of figure that out. You know, I think you're one of the guys that's leading the charge in Canada. We love coming out to Toronto and talking to you. And you know, it's this crazy community. We're trying to foster it in Canada, and we're still in the early nascent stages of it. It's a fascinating community because you can talk to absolute best PhDs in the world as easily as you could the guy next door. So can you talk about that a bit, Sam, and what your experience has been there?
I would call it an eclectic community. There's lots of very, very intelligent, certainly more intelligent people than me that are doing this at a very, very high level. But I look at the ability to also reach out and connect with them if I want to. I can phone the two of you if I have questions. You're available. I probably, if I met him personally, could have a very, very good conversation with Cliff.
Yeah, he's a good guy.
Or the team from O'Shaughnessy.
Yeah.
I know last year when we were all at the March, I had a great conversation with Corey Hofstein of Think Newfound. So there's lots of people, and I would call the community very, very small. So everybody knows each other and everybody's there to help each other out. Because being a quant investor is a different breed. You're not chasing after anything. You're trying to get the best return for the least amount of risk. So It's also accepting that sometimes what you're doing is just not going to work.
3 or 4 years ago, when I made the transition into the finance sector and landed with Art in quantitative finance, I was expecting a very cutthroat, very mature industry, dog eat dog. But it's been amazing to me, the collegial collaboration, because if I listen to Wes and his thesis, it's about the fact that this academic community that is studying markets and trying to help inform our decisions about how to make good investments, their whole modus operandi is completely different. It's about getting published in the best journals and defending your peers from ripping apart your latest analysis and hypothesis associated with the market before it becomes sort of widely accepted. And it's just a very different sharing, open environment, because all of the practitioners that we're dealing with have come from that kernel of academia.
Yeah, and why I'm excited about the new advisors is that the unfortunate part of the financial services business up until 2000, when you could do fee-based and the stuff that's coming out now, the incentive structure actually informed your motivation, and they became one and the same. And the motivation was not to actually have a successful investment experience. It was to make as much money as you could.
Transact.
The sad truth of the business is that this change is afoot, but it's taken a long time in Canada. What is so refreshing to hear you say that, Rod, is what drew me to it. When my motivations changed from all the things we were doing, it was an attraction versus a promotion type of thing, that you attracted these people and then you found that they were seminally interested in the win-wins. And it's a very interesting community in that sense. And how have you found that, Sam?
Yeah, very supportive.
Art, were you just saying that Sam was attractive?
He is attractive.
Hopefully a good John Deere one, at least. or Massey Ferguson. Those are the big red ones, aren't they? Massey Ferguson. I think community matters in a lot of different ways. Internally within your own firm or your own business, however I think the ability to foster not only support, but also a willingness to accept challenge to what you think in a constructive way. I think that makes things a lot more robust. I think it makes your business a lot better.
Do you see in the Canadian landscape with your peers is biased towards strategies that are, sort of quantitative in nature and based on scientific method, because that's kind of how their bias is? What's your sense of the rest of the industry? Are we still going to lag the States as an example, or do you see people starting to catch up? Do you see your peers and the information that you're getting in one of the, I think it is the biggest shop in Canada in RBC Wealth, are things starting to change?
It will change. I think one of the things is the US has always just been more innovative and more on the cutting edge of things than we are in Canada. It's part of how they are. It's built into their fabric, and our fabric is a little more reserved, a little more slow, and not nearly as ebullient in terms of how they want to promote themselves. The other thing that benefits the US is it is significantly larger than us.
Mm-hmm.
So that allows you could build a very high quality quant business with $1 billion in the US quite easily. It's still a minor percentage of the overall US industry. In Canada, there's economies of scale are smaller, so it's harder to compete with a very, very small business. Yes, it's going to continue to modernize. One of the best things that I think that RBC did was years ago, they put a lot of money into the financial planning and the wealth management side of things. We've got financial planners, CFPs. We've got people behind the scenes that deal with farms. We've got people behind the scenes that deal with business owners. We've got people that deal with cross-border taxation. And that's all something that's built up in the last 10 to 15 years since I started. And I think that's a major reason why RBC has really become quite large compared to the next two in our industry. Things like Quant are going to become a lot more of the next stage of growth and the next stage of modernization, because the computer technology is now there. The ability to mine all the data that you need to test out and find the right positions based on what you're trying to do is now there. It's available. It wasn't 10 years ago. It took forever to go through millions of lines of data. It takes minutes now to do it. And that makes a big difference.
At the end of the day, we knew probably the high fee model, we had to add more value in the industry. So the value was on the wealth management and the planning side. And advisors for a long while were told, don't focus on product, don't focus on money management. You have to make this transition. This transition's seminal to the future of the business. Well, we're 10 years in, and Sam iterated it earlier. Well, you used to be able to actually win a client by saying you had wealth management and financial planning. Well, that's just table stakes now. Now it's coming back to, okay, I've got all of these great things. What people will soon realize is that, the data is the data. If you're using active managers, they're probably going to underperform a beta and blend portfolio by about 2%. Well, you're not going to start to meet your plans. You're going to start to have real issues. I agree with Sam. I think the shift's going to come back, not to product per se, but just to how do I take all this professionalism that I've now built in my business and then take that to the next level. And I think that's a very prescient insight he has.
The other thing that I think is going to be really, really important for particularly the younger advisors is to be able to find your own voice and then also put that out into the world. I'm actually downtown right now. I'm about, when I'm done, I'm going to go shoot one of my monthly videos here in our film studio. And that to me, I think, is my way of getting my own voice out. Yes, I'm part of RBC and it's fantastic to work here. I get lots of support and they've been very supportive of me getting my own voice. But I think what allows me to appear on podcasts and go to seminars and conferences and speak is that I'm trying to build my own voice and how I want to run my business and the people that I will attract that way. And I see a lot of people that are hesitant to do that. And I think you need to step up. I think you need to be willing to put yourself out there. It doesn't have to be wonderfully well-written stuff. Trust me, there are far better people out there writing on investments and financial planning than I ever will be. But it's my own voice. And I think we all need to be able to find and build our own brand within whatever firm or company that we work with.
How would you describe the Sam Rook brand?
I'm here to help. I'm here to give you the guidance that you need when you need it. I'm here to also tell you sometimes when things are astray and get you back onto the path that you want to. I want to be the person that you come to for all of the important decisions, and the person that you trust will make the best decision in your favor. Not my favor, your favor.
Yeah, and I think that's a huge point, is that Sam is doing the actions that lead to a trusted advisor. I think getting your own voice is critical. And one of the reasons we started SmartBe, Sam, is I went through that transition myself into a lot of these tough areas. And I was fortunate to have people like you have. But one thing I hope to encourage young advisors is that seeking out mentors who have done Quant and the people that can help you to talk about these topics so that you can build your own voice is lacking in Canada. And that's why we're existing, not to toot our own horn, but that's going to be one of the big benefits of dealing with companies such as ours as guys make that transitions.
Yeah, mentorship really, really is an important thing. I would love to see a lot more of it. I'm thankful for the people that have helped me understand as I've built up on the Quant side and even on my own branding side. There's lots of people I've spoken to over time and totally agree. The more that we have, the better our industry will be, the more professional it will be, and the better the results for everyone will be, including the clients.
Well, and it's something that's earned, and you hit it right on the head. That is what SmartBe is trying to earn and why we're trying to do these podcasts. And Sam, you've been just such a terrific guest for us today. If I sum up some of the main themes that I took from you, it's really about planning first. Notwithstanding the industry is moving towards a planning table stakes, your ability to be holistic in planning, whether it's tax or estate or just understanding financial objectives, is a cornerstone to having a successful wealth management practice. The other theme that I got from you was, as your journey and evolution and number of years of service, you're moving towards discretionary management, you're a portfolio manager. That act of moving to discretion levels the playing field, that you have the ability to provide a similar level of service to everybody, irregardless of the length of time that you've known them, the size of their wealth, or where they sit in their journey. And I thought that was a fantastic takeaway. And the last takeaway for me was focus on a niche. If you want to grow a successful business and become integral to the relationships that you have, you really need to think hard and long about your niche. And you've identified a niche, especially in your second half of your business, that's moving towards ETFs and pure quant strategies, not necessarily the one that you had inherited, in this high-tech, white-collar young workers that have very specific needs around potentially ultra growth and stock options and RSUs and all of those other things. So it was a really fantastic discussion today. Any last words before we wrap up?
Well, I wanted to thank you too. Appreciate all the work that you have done, not only for me, but for a lot of other people here in Canada in the industry. I wanted to wish both of you good luck. Rod, I know you're going to probably do the full 28 miles.
If my body lets me.
And the March for the Fallen. Art, I've heard you might get the electric bike out
to
do it. So I'll be marching here in Toronto with a good group. So we're really looking forward to the March for the Fallen. And also I wanted to say both to Rod and Art, I appreciate you.
Yeah, thank you.
Thanks, Sam. We appreciate you as well. Listeners, you've been listening to The Modern Investor Journey. My name's Rod Hurd, co-founder of SmartBe Wealth. I'm with today Art Johnson, my co-founder and partner, business partner, great guy. We've had the pleasure of listening to Sam Rook. Sam is a portfolio manager and wealth advisor for RBC Wealth Management in Toronto. Thanks so much, Sam.
Thank you.
The information contained in this podcast is 1, for Canadian residents only, 2, for informational purposes only, and 3, not intended to be, nor shall it be interpreted as, a recommendation or the provision of advice, including without limitation financial, investing, sales, marketing, legal, accounting, or tax advice, and shall not be relied upon by you in that regard. SmartBe Wealth Inc. cannot guarantee the accuracy of any information contained in this podcast that is derived from third-party sources, although we believe those sources to be reliable. SmartBe Wealth Inc. and its affiliates may receive compensation derived from investments in or sales of its products or both. SmartBe Wealth Inc.'s products described in this podcast may not be applicable or available with respect to all investors and may change without notice. Past performance does not guarantee future comparable results. Exchange-traded funds, ETFs, are not guaranteed. Their values change frequently and past performance may not be repeated. Investors will pay management fees and expenses, but they will not pay commissions or trailing commissions, and they may experience a gain or loss from their investment in or sale of an ETF. You may request a prospectus for an ETF from your financial advisor by visiting smartbewealth.com or by calling SmartBe Wealth Inc. at 403-930-8693. The prospectus includes investment objectives, risks, fees, expenses, and other information that you should consider carefully before investing. Please consult a lawyer or tax professional regarding your specific legal or tax situation, respectively.